Welcome to Achieve Wealth through Value-Add Real Estate Investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hi, this is James Kandasamy. Thank you for listening to this podcast. I appreciate you. I know I provide a lot of value through this podcast, and I want you to share it with your friends, with your families, and anybody else that you know that kind of benefit from listening to this kind of content. Go and share it through Facebook, through LinkedIn, through Twitter, through Instagram, or any other channels that you want to share it, because sharing is caring. Thank you. Let's go on with the show.
Hey audience and listeners, this is James Kandasamy with Achieve Wealth through Valueadd Real Estate Investing Podcast. Today I have Ellie Pearlman from California. Ellie, did I say your name correctly?
Yeah, you nailed it.
Awesome. Ellie is a sponsor who owns like 2,000 units as a GP and LP, and as a GP and as an active operator, she owns like almost 770 units asset under management, almost $100 million in assets, and she focuses a lot on Texas, Florida, and Georgia, all the states that are opening early.
Yay.
Right. So, and she's in California right now. Is California opened?
Not at all.
Okay.
I think, so I live in Santa Monica. It's part of the LA County. And we're one of the last counties to actually reopen. So Orange County, they've reopened their economy a little bit. So you can sit at restaurants.
Got it.
Here, it's kind of a ghost town. You can't do anything.
Got it. Yeah, that's awesome. That's a complete difference between a business-friendly state and a non-business friendly state, I guess. But that's okay.
Exactly.
Yeah, Ellie, welcome to the show. Why not you tell our audience about things that I would have missed out about you?
Sure, James. So I'm really happy to be here. Thank you so much for having me. I've been in real estate for over a decade now. I've experienced 2008. I was not an investor back then. I was a commercial real estate lawyer, and I've learned a lot from my clients' mistakes, especially being aggressive and not conservative, and what that can do to you in times of recession. And that turned me into a very, very conservative operator and investor. I'm basically originally from Israel. I was born and raised in Israel, and I moved to the States about 6 years ago. I went to MIT and got my MBA degree, and shortly after started Blue Lake Capital and decided that, hey, I was in commercial real estate law. I also did property management back in Israel. Now I've came full circle. And investment in multifamily properties was the thing that I wanted to do. I saw a lot of potential there, especially the resilience of that asset class is what drew me to multifamily. Mainly, that's the main reason, among other many good reasons. And that's what we do. I mean, we buy Class B properties in A and B areas. We like value add deals like many other operators, and for a good reason. And we're very hands-on when it comes to operating and managing properties. And as you mentioned, we invest in Texas, Florida, and Georgia. They reopen the economy. Probably will know several months from now if that was the right decision to do it now. But it definitely helps, to with collections and with leasing activities as what we see, today.
Yeah. You're living in really two great worlds, in the California with a nice weather and a good investment world in, Texas, Florida, and Georgia, right? So that's awesome. So let's go into details about your deals of this, what you have, like the 700 units where you are the operator, right? When did you get started? And I mean, what was the aha moment that when you were a lawyer, commercial lawyer, what was that aha moment say that, okay, I'm in the wrong profession, I better go to the other side?
Well, pretty early on, I remember that at some point I was with, one of many meetings, because lawyers love meetings, because we actually, and I
make
say
money
we,
or
I'm
doing
not,
meeting.
Exactly. And in one of the many meetings, I was sitting there, was a round table, really big, conference room. And my clients they were actually developers, and they were building apartment buildings in East Europe. And I remember thinking, I'm sitting on the wrong side of the table. I need to be them. I need to be the entrepreneur. I need to be the investor. Because, as a lawyer, if you work, you bill, every hour is a billable hour, and you can make nice money. If you don't work, there's no income, there's no money. Unless you're, a partner and you bring some clients, but that's a whole different story. And I realized that I wanted something that has more cash flow stream and something that I can grow. And when you're relying only on your own profession and 100% on your 10 fingers and what you do every day, there's a limit to how much you can make. There's a limit to how much, your income is capped. And in addition, I found it more exciting to actually be part. I want to take part of the action. I wanted to search properties. I wanted to speak with investors. And that looked a lot more interesting and exciting than representing them and negotiating with banks, creating contracts, negotiating with vendors and contractors and subcontractors. I learned a lot, but I felt that I have some potential that was not being fulfilled by doing what I was doing at that time. And that was my kind of aha moment.
Got it. So did you, I know, sometimes, while we're doing our full-time job, right, professional, like, lawyer, doctor, engineers, or in any W-2 job, right, any other W-2 job, sometimes you have that feeling like what you said, right? Oh, I really want to enjoy something else, which is more interesting. Is it, as part of you growing up, did you have certain things that you enjoyed more when you grow up that you think resonates well with, a real estate, searching and operating real estate?
Growing up, no, not really. I grew up pretty poor, actually, and so I didn't see a lot of investors around me. And buying a house, your main residence was the biggest thing that I could think of at that point. It only came through education after I went to law school and through, kind of learning about real estate during, my career, from observing what's happening around me. But as a kid, there was nothing that could really tie me to real estate at that point. It was way too early.
Got it. So that's very interesting. What about these deals that you bought? Can you talk about the first deal that you bought and what are the challenges that you had on that first deal? And how many units was that?
Yeah. So I think for every first deal, there's always, kind of chicken and the egg. You don't have experience as a multifamily operator. So, you need to kind of convince the broker to give you a deal even without experience. And how do you speak with investors and bring capital if you don't have that experience? But if you can't convince them to work with you, then how are you going to get your first deal? So for me, the way to kind of bypass this hurdle was to partner with someone that had more experience than me. And through that, my lack of experience specifically in operating properties was not the main focus, because then I was working with someone who was more experienced. So that was one way. And I know a lot of young syndicators and aspiring syndicators, if that's the path that they're taking. You can also, I also see syndicators are just, they just find a deal and they manage to basically work with a small group of investors that, usually it's not a huge deal. It's not a large deal, but they're able to do it. And I have a mentoring program today. I teach people how to do what I do, and it works. And I believe in that method because I also had a mentor and I paid someone to teach me everything. So I'm not going to work with investors' money and learn and, make mistakes, throughout the way. Now, mistakes are inevitable. I think we're all going to make them at some point, but you can definitely reduce the magnitude of the impact of your mistakes if you're working with someone that has more experience.
Got it. Yeah, sometimes it's, people don't see how much money we spend or how much time we spend to learn from others, to shortcut your growth, right? Your development. There's no such thing as we came up on our own, right? I mean, there's always a mentor or
Yep.
something that has driven us to get faster, to get somewhere faster, right? Especially in multifamily investment, which is a multi-million dollar investment, right? And it's not easy for anybody out there to just go and do multifamily. So let's talk about some of your properties right now during COVID-19 right now, right? So how's the property performing? Can you give us some numbers and performance and, how did you guys do it, etc.?
Yeah. So, back in March, there was a lot of uncertainty and we didn't know what to expect. Part of it was kind of the media frenzy that was basically shouting, tenants are not going to pay. There's going to be a huge default. And we weren't scared, but we were definitely concerned because we just didn't know how hard our properties are going to get hit. And we decided to be proactive pretty early on. So during mid-March, we came up with a plan. We basically created a kind of a payment plan and with tenants that lost their jobs, and so basically allowing them to pay in installments throughout the month. And we created early bird discounts. So basically during March, if you're going to pay for April before April 1st, then you get $50 off of your rent, for instance. And we had a lot of tenants that took advantage of it. And what happened is that some of them actually lost their jobs by April 1st, but they already paid us in advance. So that was a way to secure at least some of the collections. And that was part of making sure that collections are going to be solid. We were trying to think creatively, how can we increase income with across the board with the properties? And I know that many sponsors right now, they stopped renovating units because usually you renovate a unit, you invest $3,000, $5,000, $7,000, and then you put it back in the market, hoping you can rent it. And we didn't really stop. We basically switched to renovation on demand. So we have the model unit that is already renovated, and then we show tenants the virtual tour of the renovated units and a classic unit. And we say, you have a choice. Either you can go with a classic unrenovated units, or for $100 or $200 premium, you can get the renovated unit. And just last week, we had 3 new leases and they all wanted renovated units. So it takes us about 10 days to renovate it. So we're still making those renovations. We're still making more money. We're just not renovating without having someone that is willing to pay for that specific unit, because we still don't want the unit to sit out there, and not being rented and just be vacant. So that was another aspect of trying to boost income as much as possible. And we aggressively cut costs. So only, maintenance requests that are only required maintenance were carried. We kind of negotiated, opened all the contracts with all the vendors, landscaping, even insurance, and started renegotiating. And, we were looking for ways to save, every dollar we can save was good for us. And we were looking at the, numbers by the end of April, and April was the first month of COVID when it comes to multifamily, because March, everyone already paid before we knew that COVID kind of is an issue. And surprisingly, we actually made more money during April than compared to March. Our collections were around 99.5%. And our cash flow actually increased compared to March because we saved on costs so much, and we actually collected, we were fine. And then May came, and I think the trend is pretty much the same. We're tracking right now, it's May 27th, and we're at around 95% collections. So it's a little bit lower than the month of April, but we still have 3 or 4 more days until the end of the month. So every day we're collecting more and more money from tenants, and our property managers are knocking on doors, sending text messages, and calling tenants, and really we're very, very proactive in order to make sure that we collect everything. And in addition to all of that, there's always going to be those who cannot pay. And we have, of course, on each property, we have those who've lost their jobs. And we basically decided that those who were struggling and were good tenants before COVID, we're actually going to try and help them out. So we gave away basically gift cards to help them pay for their groceries, Walmart gift cards, to those who were good tenants before COVID, and now they're just struggling. They can't pay, or they made us partial payments. Because, we made good money when times were good, and they were a big part of our success, our paying tenants. And the second thing is, I think there's something a bit, humane about trying to help those who are struggling right now. We also, hope that would help them give a higher priority on paying their debt once they're back, to work and they're making money. But definitely the stimulus checks were helpful. The moment we knew that they got stimulus checks, we made phone calls, and some of them came and paid. If we weren't following up and just hoping that they will come and pay, some of them would probably use the money for something else. Now we have unemployment that is helpful. And Texas, Florida, and Georgia, they're all of those economies are back. They're reopening, and many have rehired basically, and that also helps with collections.
Yeah, we are just checking all our residents on how many people are going back to work, because that's important, right? So once July ends, the $600 additional from the federal government, $600 per week, is going to be ending. So we are starting to check how many people are got jobs and how many hasn't, so that at least we know how bad it's going to be after July, right? So you're absolutely right. I mean, people are paying. I mean, I'm sure your concession or your gift card that you gave was help them to make a decision to pay the rent, right? So, but aren't we so surprised and delighted that people are paying rent without all the laws that they have to follow, right? We don't have to threaten them with evictions. We don't have to threaten them 3-day notice, and people are still paying, which is good. And this is good, absolutely good for us, right? It just reiterates multifamily asset class, food, shelter, and safety is very important. And they can't go and spend anywhere else. They can't go for a vacation. They can't go for a movie. They have to pay for shelter and food, and maybe they buy a massage chair, like one of my residents did, right? So a massage chair, and some people bought new cars. There's a lot of people buying new cars because there's so much deals going on the car. But the good thing is they're still paying the rents. Yeah. So do you own your own property management company?
No, we actually hire a third-party company, and they're pretty big in the industry. They manage over 40,000 units.
Got it.
And that's why kind of early on we realized that we're good at finding investors, finding deals, and managing the asset. Our core focus is not property management, especially since I'm here in California. And this is the great, match between a company that sits, in Atlanta, for instance. They know the market inside out. They have people there that are sitting in the office and helping, collecting leases and signing, collecting rent, signing new leases. And we're almost on a daily basis, we're in touch with them since COVID started. Before that, it was probably maybe 2.5 times a week, on average. And now it's almost every day, multiple times a day. So we're very, very hands-on, and I couldn't be happier. They're actually doing a great job.
That's awesome. Did you find any resident that ghosted the property management company completely? Like they don't want to talk, they don't want to, have you seen that?
Yeah, we always have those.
I do have that too. Right. So.
Yeah, inevitable. But thankfully, it's a very marginal phenomena. You don't have 5 or 10% of your tenants just ghosting on you and disappearing.
Correct. Yeah, there's always some small percentage of people doesn't even want to take a free money given by the cities, right? Like in Texas, I mean, Dallas, San Antonio, Austin. I'm not sure about Houston. Probably they have done it. They did give a lot of assistance to the residents who can't pay. I'm not sure in Florida and Georgia. Did you see that? I mean, did the government or city give out any assistance?
Nothing out of the ordinary besides, stimulus checks and unemployment.
Yeah, I don't know. There's a lot of programs in Texas that give assistance to residents who can't pay, who lost job and all that. So yeah, we did take advantage of some of the program because, whatever money we can get from the government to help out our residents who are struggling. I mean, the more flush we make them right now, it's going to be better later on, right, for the next few months. So we are going ahead and do that. So what about the value add strategy that you do on your deals? What worked the most? What's the most valuable value add have you seen?
Usually it's a unit interior, and you don't have to go all the way and make a beautiful brand new apartment. There are a few things that are an eyesore for tenants. Usually, a freshly painted, unit that's a must. But in many cases, replacing the carpet with vinyl flooring is what we do. We keep the in the bedrooms, we keep actually the carpet because tenants don't really care about that. And it saves us, it cut the costs at least by half sometimes. Usually it's just the normal things, black or stainless steel appliances, painting or the cabinet doors in the kitchen, maybe backsplash, new lighting. And sometimes we pick and choose. We don't do all of them. So there's a really good market research that goes into it before we start doing anything. It's very tempting to say, I'm going to spend $5,000 or $6,000 or $7,000. I'm going to make a beautiful, apartment. But sometimes you're in an area where people cannot pay for you to have a decent ROI, or they're totally fine if the apartment is it looks good, but it doesn't have stainless steel appliances. It has black appliances. So we do market research. We actually call all the other comps and we look at the pictures of their renovated units, and we understand what's the scope of the renovation around us and how much they're charging and as a premium. And based on that, we know what tenants like. It's also a conversation we're having with the PM, the property manager, and they tell us, yeah, in this market, they're not going to pay you $30 more if you're going to give them a unit with stainless steel appliances and not black appliances. But they really care about the carpet. And so that we kind of adapting to the market, and we're adjusting the scope of the renovation based on the demand and the ability to pay for all those upgrades.
Got it. Yeah, that's absolutely right. You want to look at what the market can support, right? Not do random renovations, right? And a lot of people have failed when they move from one city to one city. And I've seen people move from this city. They're so used to spending $5,000 a door in one city, and they go to the next city and they try to spend the same amount of $5,000 a door, and it doesn't work, right? So. It's so interesting on how the demographic is able to support it and not, right? So that's interesting. What about deals? How do you underwrite deals? What kind of sniff test do you do when a deal is given to you? Like today, they say somebody's sending you a deal. But before I go there, are you expecting prices to go down in multifamily post-COVID?
Yes, but not in the immediate future and not as much as most people expect. I don't think there's going to be 20-30% discounts for several reasons. One, as you've mentioned, collections. We're doing pretty well with collections. I know some properties are collecting around 70, maybe 80%. So not everyone is doing great, but we're not talking about a 50% drop in collection that can basically, justify, fire sales. On the other hand, and not on the other hand, but in addition, you have forbearance. So for 90 days, owners who are in trouble now don't have to pay the lenders. So they're not motivated to actually sell the properties at a discount. Most of the discounts that I've seen today of deals that were closed during April and May and early May were around, I would say, 4 to 5% discount. The problem is that there's a huge gap between sellers' expectations and buyers' expectations. And buyers, many buyers want to buy a property at a 15-20%, decrease in price, a price cut. And sellers are saying, we're doing well. Why would we sell you at a discount? Now, what they're failing to understand many times is that collections is only one part of the equations. So even if you're collected more than March, there's two other main things that have changed. And this is also answering the second part of your question about how we underwrite deals. First and foremost, the debt has changed significantly from March. So if in March it was easy to get 70, 75, maybe 80% LTV, right now we're talking about 55 to 65, maybe 68%. So when you take a property with the same income, let's say NOI is the same pre and post COVID, but you have a deal that you only get 55 or 60% LTV versus 75% pre-COVID, guess what? Your returns are completely different. Correct. And that one part, I think this part sellers don't fully understand. And then in addition, when it comes to our projections, pre-COVID, we were using softwares that had predictive models about vacancies, concessions, rent increases, and we use those, numbers along with, it's a combination of those projections, conversation with our property management company, and how the property was basically performing up to that point, and came out with a number that makes sense. Now, regardless of what those models are showing us, I'm comfortable buying if the deal makes sense with very little or 0% rent increases in the first 12 months. And that also affects the price that we can pay, because obviously you have, the first 12 months, you can't really raise, prices, raise rents, even though I have to say that in some of our properties, we are able to lease only with 0 rent increases. But on other properties, we just raised rents about 18% higher during April because we were offering renovated units, what I've talked about before, renovation on demand, and people are willing to pay a little bit extra. So during April, we're actually increasing the rents on some of our properties by almost 20%. So even though that is happening, I can't really trust that would happen with the next property. And so in order to be conservative, this is what we do. We increase also the bad debt or delinquencies and increase concessions more than what we usually do, pre-COVID. So all those factors alongside with the debt, basically, that affects the returns that we're looking at. And that's why the numbers, the prices that we're willing to pay for property, they're not the same like they were before COVID.
Yeah, there's other factors like, the debt. And I don't know whether you talked about the reserves that the lenders are asking right now, right? On the Fannie and Freddie. That's going to, additional cash out of pocket, which reduces your return, even though you're supposed to get back that money in the 12 months or 18 months that, after the deal has been meeting certain threshold, right? So that's very interesting. So let's go to a bit more on the personal side. After you're starting doing your real estate business, right? I mean, is there any proud moment that you had, that you're really, really proud of, right? That, it takes you until the end to forget it. I mean, you can't really forget about that particular moment that you're really proud of yourself.
Well, we had one property that when we got it on a contract, it was 98% occupied. And after 90 days, we were, or I think 80 days, we were close to the closing date. And we were asking for the latest rent rolls and T12 because we're always, looking at the new financial information. And I'm looking at the rent roll that the seller is sending me. And I'm staring at the numbers and I'm not sure I'm seeing it right. But apparently the property is about 80% occupied. And he didn't tell us anything. He was hoping we're not going to notice. It happened over a few weeks. And we about less than a week before closing. And we just find out that the property that was 98% occupied is 81, 82% occupied.
So it dropped within a couple of months?
Within a couple of weeks.
Wow.
Yeah. So, and we're starting to kind of scratch our heads and say, what happened here? And we kind of discover an interesting story where basically the seller was self-managing the property. He thought he was saving money by doing it by himself. He left a lot of money on the table because all of his rents were under market. So when we took over, we just increased rents by $85 almost 10% increase without touching the units, because we had to push the occupancy back up because we knew it was under market. But he was self-managing, and he wasn't really treating his employees and his tenants the way they should have. And at some point when they heard about the sale, the entire team just got up and left, and they all just quit. And he had to bring a third-party company last minute. Third-party company comes in, they're looking at the property, and they say, okay, those who are a little bit late, paying their rents, they just started evicting people. Wow. There was a woman, one of the stories that I've heard, a woman that came back from the hospital after she gave birth, and they evicted her because she wasn't paying on time because she just got back from the hospital. So they basically said, we have very strict rules, and we're basically, we have the set of rules. And so if we don't think they should be here, they're not going to be here. And that's how they ended up at 82%. And the owner I don't know if the owner even knew. I think he was hands off at that point. He felt that, he's almost selling the property. And we didn't know if we can close because I had investors that knew that they were buying a property at 98%, not 82%. The first thing we did was obviously, communicating that with everyone and saying, this is the situation. And we also have a plan of what we're going to do. And I wanted to give, investors the opportunity to say, hey, you know what, it's not the type of investment I want to be part of, but nobody did. We renegotiated with the seller and said, now the property is not worth as much as it was 3 months ago. And we also had to negotiate with Fannie Mae because now the property is not stabilized. And so Fannie Mae only gives you a loan if the property is stabilized, meaning 90% occupied for 90 days. And this is not a stabilized property. And we worked with Northmark. They were a great team, and they went to work for us and basically said, we can vouch for those sponsors. They're great operators, and convince Fannie Mae to keep the loan even for an unstabilized, property. So that was one of the, I think, more interesting deals that I was part of. But it turned out to be fine. We, our property management company were able to, bring the occupancy back up to 90% within 48 days. And the property is, doing a lot better, and collections are good. And it's interesting when you're in that moment, you're not sure how the property is going to perform. But when you have a really strong team, it makes all the difference. And yeah. I was blessed to be working with a really, really good team.
Got it. That's very interesting because Fannie and Freddie, they expect the property to be stabilized until they close, right? I mean, they'll keep on asking you for rent roll until you close. So it's very important that's a big drop to 82%, right? Just crazy, right? So, hey, Ellie, thanks for coming for the show. Why don't you tell our audience how to get hold of you?
Absolutely. So you can find more about me if you go to elliepearlman.com. And I also have a free guide for you if you want to look at a deal. There's basically a free guide you can download on my website that will basically teach you all the things that you need to look at when you're evaluating a deal, all the crucial deal components. And that's basically how you can reach out to me. If you want to email me, my email is ellie@elliepearlman.com.
Awesome. Thank you very much for coming onto the show. I'm sure we had tons and tons of value from your knowledge and our discussion. Thank you.
Thank you, James. It was fun. Thank you so much for having me.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.